Hi, everybody. It's Bob Icino from Path Trading Partners and the Pure Exposure Growth Series. It is Monday night, February 10th, 2020, and I want to talk to you guys about what happened in the markets today and what I see and what today told me. We had another bit of a rally today. We had the NASDAQ up 1.13%. The S&P and the Dow both up about 60 basis points, give or take. So a little bit more than a half of 1%. Even the Russell up about 66 basis points, I believe. Again, a little bit more than a half of 1%. There was okay volume in the overall markets, and the activity wasn't just the open. It was pretty consistent throughout the day. Now, there were some good things that happened. Obviously, we're coming off the back of a very strong jobs report. But that coronavirus continues to spread. So why are the markets continuing to rise with this coronavirus not contained at all? And I think that's a very big concern. So look, the structure of the market itself is not good. Okay, the market rally is coming basically from four stocks. You can calculate that as of Friday, the rally we've gotten in 2020 comes from four specific stocks if you do it relative to the S&P. 67% of that rally comes from Amazon, Apple, Microsoft, and Google. That's it. As a matter of fact, in the S&P 500, 82 stocks are in a bear market. Over 200 stocks are down on the year. Now, that's without today's data in them, so it's probably a little bit better of a picture than that. But that doesn't take away the fact that four stocks are driving this. So what does that mean? Well, nothing if you're an index trader. Doesn't mean anything. Okay, you don't really care why the market goes up. But market structure is an important thing, and it needs to be talked about a little bit more. When you're looking at it from a price action perspective on the indexes, you don't really look beneath at the structure, you look at the price action, because stocks that are on their way higher tend to continue in that direction, as we've seen for the last, 90 years. Okay, but from a perspective of the structure itself, we are vulnerable, which is why the put to call ratio continues to favor the puts. As a matter of fact, some of the people we talk to are selling covered calls, but they're using that premium from the call not as profit, but to buy puts. And that is probably a smart thing to do, given that this coronavirus is now approaching 40,000 cases from where I last looked, over 1,000 dead from where I last looked, and it doesn't seem to be slowing down. We got our first case reported this morning, according to the World Health Organization in France. A person who did not travel to China actually contracted the virus. That's kind of a little bit of a scare point. Again, from an economic perspective, obviously, as humans, we feel for the people that are sick, but I'm speaking to you guys about stocks, investments, and economics, not about the medical part of it. I don't have the head for that. I don't claim to. So equities continue to be strong from an index perspective, weak structurally. So you have to be careful of that. Crude oil fell again today. I've mentioned multiple times, both on TV and on videos, that I'm looking for the low 48s before you see any kind of basing. Russia finally agreed to talk about a production cut. The number that's being thrown around is 600,000 barrels. We won't know what effect that's going to have on the market till it's actually announced, but I suspect that any sort of rally in crude oil has to come from the demand side. It can't really come from the supply side. You take away supply to meet demand. The only way that that's going to really push prices higher is if all of a sudden demand moves past that sort of supply curve and takes care of the glut, and we haven't seen that yet. So what are we looking at as ways of potentially taking advantage of what might happen in the markets? Well, that's something that we're going to talk about in detail in the next Pure Exposure Growth Series, which is coming up. Okay, it's only 8 days away. It's February 18th, 9 a.m. Central start time. Now, going through the list of people that we have on this show, I've done it before, but I'm going to do it again because it is a fantastic lineup. We've got Roger Curry, who is the founder of the Market Forecasting Academy. I've got Anthony Grisanti, Grizz, a good friend of mine, president of Grizz Energy. He's a good friend of mine. He's a CNBC contributor. I've got Mike Arnold, who's my partner in Path Trading Partners. Tony Zhang, who we've had on before, also a weekly CNBC contributor on their options show. We also have Bill Baruch, president of Blue Line Capital, Blue Line Futures, another CNBC guy. We've got Jay Soloff, who is the lead option strategist at Investors Alley. We have an absolutely loaded lineup for you guys. And the thing about this particular lineup is it's going to be about what to do during black swan events or potential black swan events that we may see coming. Now, we're also going to talk about individual trades. You don't have to say, wow, this is going to be a doom and gloom show. It's not. Here's the thing. So one of the things we do at Path Trading Partners is we write analysis for firms, and then they put it under their name. So you don't know it's Mike and I writing it. Okay, you don't know it's us doing the forecasting or the fundamental analysis. Something I wrote yesterday, actually. I wrote that I thought one of the best trades that might happen that sounded crazy was to buy Slack. The symbol is WORK. All right, now there's no way for me to prove that I wrote that because it goes out to an institution, they put it under their name, and that's that. But today Slack was halted because IBM is going to not take a stake, but they're going to put the Slack platform into their company, and 300,000 employees are going to be using Slack at IBM. This spiked the stock 15% before it was halted. We put that out yesterday. Now, again, I have no way to prove to you that I did that, okay? If you know me, I'm not the kind of person that makes that up, but I don't have any way of proving it to you. So why don't you sign up at PureExposureGrowthSeries.com, because that show is live. So you'll see what we actually do. Last show we bought Disney about 132 and change, took it out to about 150 and then got out of it. We keep in touch with you after that and tell you what we're doing with the trades. Now, I don't want to pitch you guys on anything because there's nothing to sell you on this show. This is a free show. You get a free pass at Pure Exposure Growth Series. Now, when you type that in, it is PUREX. Okay, we didn't double up the E's. Pretty clever. It's a big X if you see our logo. But I think you guys should sign up and watch the show. It's coming up on February 18th. Hit that little reminder when it gives you the link so that you get reminded that the show is going to start, because it is live. It is 9 a.m. Eastern time. We encompass the market open. Okay, we'll talk more about some of these things like the market structure and potential black swans outside of the coronavirus that could affect markets and how we're going to play those, and also how we're going to do things going forward. And a quick hint for you, not everyone on my show thinks the market's going down. I don't even really think it's going down. So sign up so you can see what's going on, get a reminder, and I'll come back to you guys in a couple days with more market videos. I might actually have some specific trade ideas for you in the next couple of videos. Thanks for watching.